Thank you all for coming back from the break. We're approaching the end of the day, and we've left one of the meatiest and most challenging topics for last. It's not quite solving for world peace, but perhaps not far off. We're talking about resilience, driving social impact as a sector. I think this is a particularly important topic for us to close on, because ultimately this cuts to the heart of what we do as an industry. But it's proven to be a stubbornly difficult challenge for us to address and make the right level of impact. If we focus this really on the question of natural catastrophes and disaster recovery, the global protection gap has been sizable for many years. So last year it was $318 billion of natural catastrophe losses, 57% uninsured. That is actually better than any of the previous years, so you might start to say we're making good progress as an industry. I think we are making progress as an industry, but probably the data is somewhat skewed. So last year, many of those catastrophes happened in the US, which happens to be one of the better insured countries. In fact, when you strip that out and you look a bit deeper, the numbers start to show a bit more cause for concern. So one of the previous panelists was talking about two different types of the protection gap. So that which is driven by risk and uninsurable risk. And we start to see a lot of that occurring in certain locations, Florida, California, Australia. And in fact, within the numbers last year, of course, we had Hurricane Helene, and less than 5% of those economic losses were in fact insured. Of course, the second area relates to affordability of coverage. And when you then start to break down the insurance gap into the developing world, that protection gap is closer to 90%. So I think there's still a lot more that we can do as an industry. And so to try and deal with that question today, I'm very lucky to be joined by a fantastic panel of specialists. To give the conversation a bit of structure, we'll start with a little bit of context. So, how are we dealing with or how are we seeing the protection gap emerge in different segments, and what are we seeing as progress that the industry is making in addressing that protection gap? We'll then go into what some of the barriers are. So why is this not scaling in the way that we would hope and like? And try and unpick what some of the drivers are behind that, and hopefully start to get to a few actionable insights about what we need to do differently as an industry to increase that impact going forward. So perhaps just to introduce my panelists very, very briefly, I'll just go from left to right. Remy de Pinier, CEO of Blue Marble, a fascinating impact insurer, which we'll hear a bit more about during the session today. Saoirse Jones, I got the pronunciation right, head of public-private partnerships at Zurich Insurance. I think clearly an area which we start to see as a key enabler to closing that gap, and very keen to unpick some of the challenges and opportunities there. Bill Marceau, chair of the Law and Public Policy Working Group at the Insurance Development Forum, which I think is doing some fantastic work and research on how we as an industry and as a sort of society can start to move forward on these. And Thomas Sepp, Chief Claims Officer for Allianz Commercial, at the forefront of some of the innovations of the, I guess, one of our largest global insurers in bridging the gap for particularly the commercial and SME segments. So with that, I'll perhaps start with a couple of open questions, and maybe direct the first one to you, Bill. Just around the context of the protection gaps and some of the research that you've been doing as part of the IDF and also here as part of this IIS, how are you seeing the emergence of the protection gap in terms of natural catastrophes and the role that the industry is expected to play and is playing in moving that forward?
I think everybody's well aware that the protection gap is huge with devastating impact. I think there's clearly a growing recognition of what the insurance industry can do. It's both a good and bad thing. The bad part of it is, I think people think that the insurance industry is a silver bullet, that it can solve the problems by just doing more, insuring more. And as many people here know, it's much more complicated. It really does go to the insurability of risks. It goes to the understanding among the general population, but that includes governments and others, about exactly what the insurance industry can do. I mean, everybody knows that the industry's fundamental role has been take a premium, cover a loss when it happens. So financing the risk. There's not as much of an appreciation, in this, but this is critical, to realize that the insurance industry also can help one understand what the risk is, steps you could take to mitigate the exposure, lower the losses, and that all that needs to take place. So it's, you know, the industry's really over, even the last 2 years, I would say, there's been sort of a tipping point, and particularly among, you know, the DFIs, governments, and others, which are important because it's not just, you know, corporations that buy insurance or individuals that buy insurance, but it's communities, it's states, it's cities, and we'll get on to that. That's really important. But this understanding that the insurance industry is a, you know, is a critical partner in all of this, not the solution, but a key solution. And so I think more needs to be done on that. I think conversations like this help do that. But there's a real recognition and a different recognition today than there was, you know, even 2 years ago. So that's a positive thing.
Great. Perhaps we can start to talk about what some of the, I guess, the focus areas from the individual companies that are represented here, in terms of, I guess, what part of that protection gap you are aiming to address within your firm. So where you're starting to prioritize and sort of shape your individual responses in those segments. Probably need to frame a little bit how you see the protection gap in your segment as well. Perhaps I'll start with you, Saoirse, from your perspective at Zurich.
So our focus at Zurich is really around the risk prevention, risk reduction side of things, and being able to bring our expertise to deal with exactly that in terms of how do you actually advise on risk reduction adaptation measures that you need to be putting in place before. Our focus is really around doing that, bringing our risk know-how and expertise to play for that, be it with the commercial clients that we tend to work with, but also with public sector, which is why this focus has also been part of my role, is to do that, is to work with public-private partnerships such as the Insurance Development Forum, but also with other public sector individuals more directly to understand what is their risk, how do we actually reduce it before they start either building or investing in infrastructure assets or in planning, designing new building codes, planning areas, etc. Our motto is we like to say, we've all heard about the word build back better, right? Which is equally important. We need to do that. And you need to build better before. And so that's really our focus. And how do we bring our technical capabilities and risk engineering capabilities to be able to do that? And not just to face the disasters and the climate risk exposures that you have today, but model that out into the future, and then making sure that whatever measures you're putting in place today are future-proof against future climate hazards.
Okay. We'll come back to the topic of prevention later, because I think it's a really important one. Maybe Thomas, just from the commercial segments, I think, you know, obviously there are elements where you can look at kind of households and retail, and, you know, clearly the protection gap there is particularly important, but obviously corporate protection gap is also incredibly important. These companies provide livelihoods for and employment for a number of people, and of course their resilience matters for societies. So how are you seeing this within Allianz Commercial in terms of your focus on protection gaps?
Look, there are probably two directions that we can explore. One is, as you just said, that's a conversation we see more and more growing interest by larger corporations or also larger asset owner, real estate owners, about what will then climate change do to my portfolio. Yeah, and as you said, you can model that out. The capabilities are there. We provide tools, others provide tools too. But the point is, go systematically about your different locations and work out how resilient those are going to be in 5 years, 15 years, 30 years, right? And that can come from what is your exposure to drought, wildfire, subsidence, flood, whatever we have in stock with all those wonderful perils. And as we see a growing interest and large corporations start looking into that, I mean, obviously their desire is also strongly supply chain based. Yeah, you don't want to have something fall out of your supply chain and causing business interruption. And I think the other thing we are also looking and debating, I think it's not that moving that much into action, but what do you do with new technologies, right? So battery storage, carbon storage, renewable energies, that's more developed. But what are the risks there, and can they actually be made insurable? Can they be covered? What is actually the risk? I think there are a number of conversations also running in that area. They're probably going to gain some relevance over the next, I don't know, years to come.
So it goes beyond just being there to, either advise on prevention or even kind of provide solutions in kind of disaster recovery, but also looking at how we can be part of the energy transition as an industry, which is, I think, even a broader topic. Maybe, Hemi, different markets, different segment. Can you maybe share a little bit about Blue Marble and the element of this protection gap that you are trying to address through the consortium?
Yeah, so for those of you that don't know, Blue Marble is the consortium that was set up 10 years ago. Actually, it was first announced in the forum in 2012 by Brian Dupro. I was made aware of this. So we share history with the forum. And actually, our founder was Joan Lamb-Tennant, who was in the prior panel. So a lot of connection points with the forum. This consortium, as I say, was set up to advance insurance to underserved populations in emerging markets. And so the way we're looking at it is, how can that segment that's actually, if already emerging markets are very unprotected, if we then look at the underserved segment, obviously by definition, they're the least protected and where we find the biggest protection gaps. So we picked a pretty hard problem to solve, I'll be honest. And I don't know we have the full solution. But on top of that, we've said, in order to do this, it has to be commercially viable. And that's the requirement of what we're doing. And this has been mentioned recurrently these days. If you want to do something with impact, it needs to be lasting. And so over the last decade, what effectively we have been doing is experimented with a few concepts, implementing, and what we found, and there may be other things that work, but what we have found that works is climate parametric, distributed through aggregation mechanisms, whether it is, as Thomas, you were saying, states or provinces or municipalities, or at the meso level. So this is banks, microfinance institutions, where we bundle with credit in order to get to these populations. And we couple that with payments that get to the individuals, to the households. That's important. So we get that traceability of the payments so the intended impact is done. Then we get a model, and now we have a track record of 10 years. We get performance, commercial viability, and also take-up of the products and renewals. So we're getting the basics to create a market. And so that's what we're doing and what we're replicating and now scaling.
It's fantastic. So I think you touched on a number of different areas there, which maybe we can explore a bit more in detail as we go into the next parts of the session. But it's about distribution. How do you reach those individuals? It's education. How do you raise awareness around it? It's also product innovation. So how do you develop the right types of products that enable that? And it seems like you're covering a number of those elements in your solution. So I guess then probably the first part of the session that I'd like to spend a bit of time on is delving into some of these topics in a bit more detail and exploring what it is that we're currently doing well as an industry. So a good, positive a couple of good, positive, practical stories about kind of how we're actually innovating and sort of moving this forward. And maybe the first topic that was brought up was around prevention. And I think, quite clear that as an industry, we have a lot of insight and knowledge to help with risk prevention. Open question to the members of the panel. Maybe I'll start with you, Saoirse, because you raised the point. So what are some of the leading practices that you're seeing around today? It can be in Zurich or it can be elsewhere. Some of the best things that we're doing as an industry to advise on risk prevention.
So some of the examples that I think have worked well is when it has been a group of, and I am going to be taking that example from the Insurance Development Forum, is when you're working with a group of people to, first of all, understand what is the problem. We as an industry are not very good at explaining what we do in very clear terms, in ways that people understand, that we're not just about paying claims or demanding premiums. And actually, if you're lucky, we'll pay the claim. that's kind of the narrative that's a little bit out there. If you just speak to Jane and John Doe's on the street. And we need to shift that. We need to be better explain what the value add of insurance is, not just in terms of the actual policy and how that can help you in building financial and economic stability at a household level, but also at a governmental national level, but how it actually helps in making risk-informed decisions, again, at a household, company, and governmental level, in order to be able to maintain that resilience over a longer period of time. And so the best examples that we've had is when we've had that conversation really openly in terms of what is the problem that you face and what is it that we can do to help tackle that problem. And it could be understanding what your risk is. So let's figure that out. What is your exposure to flood? Can we model that? Yes, we can. We have the tools in the industry to do that. Going to, well, how does that play out in terms of the investments that you want to make? Are you making the smart investments? Are you making the risk-informed investments? Going to how do you manage the remaining risk, the residual risk that you cannot translate out? And what are the models that you can employ for that as well, indemnity or parametric? And just having also that open conversation to saying, look, insurance is not only going to be necessarily the solution here. It's an element. It's part of your financial system, and you need to think about it as integrated as part of that financial system. So we're working with, for example, we're working with a development bank as well to understand how we can help their clients with that they lend to in understanding what the risk exposures are, help them assess the risks, and also how can they actually mitigate the risks. So for example, with a national energy provider, understanding what their impact is on the energy production from a drought or flooding. Because that then impacts their ability to provide basic services to the population. So those kind of having that open conversation with public-private engagement, I think, has been very helpful. Also, the fact that we're not speaking as one company also helps. I think there's quite a bit of distrust as well within public sector vis-a-vis the insurance sector. So the best way that we found to actually break that down is that you're actually speaking as a group, as an industry, to tackle the questions.
Okay. Perhaps any builds? I mean, do you see the prevention topic differently when you're serving kind of the developing world?
No, very similar, but perhaps applied to the context. And so in that, what we're seeing is one is the basic principle, right? And I think the UN Agency of Disaster Risk Reduction says that for every dollar spent on prevention, you save 15 in recovery, right? So that 1 to 15 ratio, that multiplier to us, just in terms of efficiency of deployment of resources, capital, in order to get, a good return makes a lot of sense. So what we're looking at is, okay, how can we apply all the learnings, in particular on parametric and on climate, to start to see if this can be used as a tool to inject liquidity just in time? And where we have started doing this is in an interesting place, the Kyrgyz Republic in Central Asia, where we've partnered with the World Food Program. And there, what we're doing is developing a parametric product based on forecast that impact livestock communities, livestock is a very important industry. And so there, what we're trying to do is, with that forecast, inject liquidity to the World Food Program to fill silos with feedstock just in time at a good price before prices ramp as the catastrophe strikes, which in turn impacts the entire livestock community, and then you have a lot of dead animals, and it has ripple effects in the entire economy. So how can we get before that and use parametric as a tool to inject that? And there's challenges in that. There's a lot of innovation. There's regulatory bottlenecks, et cetera. But it's this type of solutions that we're trialing right now, but we see a ton of potential in terms of bringing insurance into the preventive space.
Let me add one more. I look at it a little bit more narrowly in the context of really making money out of those things. And we're driving essentially then two things. The one is obviously general preparedness, as you also pointed out. That's, I think, well rehearsed. Risk engineering, going in, understanding what different sites look like. The thing we are adding also, and that's more in the retail businesses, you also need to be aware that something might be happening. So we're getting out, I think it's mostly in place for Europe now, if you have a retail policy, car policy. So if you are somewhere, you would get a message on your phone saying, there's an expected hailstorm coming, or there's a flash flood risks if bad weather systems are coming in. So think about those elements, general preparedness, but also alertness on the moment itself, in order, to have people get their assets into safety as far as possible, and not just let it flow.
Yeah. Maybe I want to come back to the point on parametric, because I think it's a really interesting topic when we're talking about the space. But just on the prevention topic, it's something that comes up a lot is this idea of sort of build back better policies. And it's a great idea in theory. You're going to have some damage, at least build it back in such a way that you're more resilient going forward. What's been your experience of the take-up of this, the effectiveness of this as a measure, or is it just something which is nice to say, but actually it's not having the impact that we want?
Well, we chatted about that in the break, right? Exactly. So, yeah, we have that on the market since a while. And how do I politely phrase that? It's not the top-selling item on our shelves. Yeah?
It's not flying off the shelf, right?
So now it's out there and it can be bought. Even, I think it's fairly attractively priced, but even then it doesn't seem to be top of mind for many larger commercial customers. Yeah, for whatever reason, I haven't figured that one out, because in theory it should be an easy thing. Yeah.
I think that touches upon, the one of the elephants in the room is the willingness of vulnerable people, institutions, governments to actually then spend the money to do what they need to do, whether that's buy a policy, whether that's to harden, buildings against flood risk or fire risk or others. It comes down to a cost. California obviously has huge exposures to these natural catastrophes, there's no doubt. Their insurance regulator, net probably hasn't been a positive influence on all of that. But one of the things he's done, to his credit, is on their website, there's all sorts of very accessible information on both mitigation measures, but also describing what build-back policies are, where they're available. Now, it comes down then to even to a homeowner. Am I going to buy a policy that probably for the marginal benefit is very reasonably priced, but already homeowners insurance is a huge, and if it's available at all. And so, as they say, you can lead a horse to water, but there's the real, and I think that's one of the big issues about these protection gaps. It's the willingness of the exposed party, whatever it is, to actually take the steps that are there, and either preventative steps or risk financing steps.
If I may build on that, it's often seen, I think, as you're alluding to, it's often seen as an additional cost, because that 1 to 5 or 15 ratio, whatever report you're reading, is not necessarily in people's minds. And at the point of disaster, you can understand it. You just want to get back up and running, right? You want to do the minimum you can so that your business is up and running, so as you as a homeowner can, find a place for your family to live. So it's really not necessarily top of mind, and it is seen as a cost. It's not really thought about, how do I actually make sure that I'm thinking about the future. You're dealing with today and the impacts today. And the other thing I think as well is that there is a bit of a disconnect between our desire and our advice in terms of building back better and actually the building codes and standards that exist. These were developed 10, 15 years ago. They're certainly not fit for purpose for today's environment, and they're not fit for purpose for the future environment. And that takes a long time. And that's, again, where you have to start working with policymakers, with regulators, and a whole host of other stakeholders in order to make that clear that you need to make this investment now in order to protect yourself in the future. And it comes down to, how do I, in a constrained financial environment, how do I allocate my resources to the best ability? Do I invest it now in a policy that potentially may pay out in future, or do I invest it now to help my community get back on their feet?
Right. Perhaps while we're talking about some of the potential solutions, and I'll link this to the parametric one because I think they're often sort of hand in hand, it's public-private partnerships. Everyone says, okay, these areas that are really difficult to insure, either because the risk is extremely high, like floods or wildfires, or the populations perhaps don't have the financial means to fund it. The solution is public-private partnership. Great. And probably do it with parametric, because that's simple, fast, quick and easy to pay out. So on paper, it all looks amazing. What's been, I guess, your experience of what differentiates the public-private partnerships that really work and really have the impact from those that fall short?
I can start. We tend to distinguish between level of development of a country and actually level of development of the insurance sector as well in order to target the strategy when forming a public-private partnership. Meaning in low-income settings, there's a lot of education that needs to be done at all levels of the system. You're talking about regulators, you're talking about the insurance industry, the entire consumer base, whereas in more, in our case, middle-income countries, right? Given the scope, we see more maturity. Perhaps there's already a knowledge and a culture of insurance. Therefore, it's a little bit easier in that regard. When it comes to education, doesn't mean that education doesn't need to be done, but it's another degree. So I would distinguish that. In emerging markets, conditional financing by multilateral agencies, bilateral donors can play a role. It can play a role of catalytic role. So Insurance Development Forum, which Bill, Jersey are part of, has this unit that creates projects through a consortium working with governments. We're involved in a few. Dominican Republic is an example. And there, what we see is that actually when you get the industry together, you get a government that is interested in a solution. And one example is Dominican Republic, where we are right now developing a parametric product, working with Social Security of the country to actually pay out in the event a hurricane strikes and distribute payments to the beneficiaries. In these settings where the right settings are there, there's willingness of the government to do it. Maybe there's a nudging or catalytic incentivizing, I don't know how to put it, the cherry on the cake, something that really gets it started and prioritized, helping jumpstart it. And you make it conditional on adopting a budgetary line at the end by the government, entity, et cetera. We're seeing that that's, at the very least, starting programs, and we're seeing interest, and we're seeing adoption little by little. So that's a form. I'm not saying it's the only one, but one we're adopting.
You know, what you could say is that the difference between the partnerships that work and the ones that don't, the ones that work are the ones that result in the purchase of an insurance product. There are partnerships that are put in place, and this is one of the, again, biggest impediments that there are. They'll engage with the industry, they'll engage with the IDF, they'll engage with Zurich, Swiss Re independently, they'll do it. It'll take 5 years. That's probably quick. Often it takes 7 years from hello, what can we do, on working through this. It's unsustainable. That's the real downfall of the public-private partnerships is and that's driven by a number of things. A lot of governments that you're dealing with don't have the background, don't have the experience. They come to the table with, I don't understand this industry. I've heard some bad things about this industry, whatever it is. So there is this trust factor, a big trust factor that's there, but it's also just the bureaucracy that takes place. And so it's I'm not to be glib, but the ones that are successful are the ones that end up with, and because the industry will design, and that's again what the IDF has done. Its first part is, okay, work with the government. What's the biggest exposure? What do you want to try to address? This industry is innovative. It's got the financial strength, it's got the technology, it can insure virtually anything and structure programs and policies almost in any way, but it all comes down to, will there be a transaction at the end? And so often it's not. Sometimes it's as fundamental as you spend 5 years, and this isn't once or twice this happens. You spend 5 years working on a project, there's an election, the new government comes in and says, that's not our priority. And it doesn't happen. So we got to crack, it's really easy to say PPP. They're really hard, to do.
Yeah.
Yeah, but I mean, maybe I'm opening a Pandora's box here, but never mind. So I think there's another element that's required to it. There needs to be a recognition by government, which we often see that some things, well, pretty much everything can be insured for the right price, right? But often that price that would be required is then seen as not really practical for the right reasons. So then it probably needs that recognition that governments need to play a role on the economics of those things. And the Pandora box is now, if I looked what happened in the Ukraine situation the last 3 years, that was much faster, I think, grain transport, so all the hull insurance required, war covers for inland marine. So if there is that recognition that it cannot be shouldered by private markets, then it can move relatively quickly. But I think it often takes a long, long time for that negotiating to bottom out.
Nothing focuses the mind like a war, I guess, is the answer there.
I mean, building on that, I think it also needs multiple levers. You need to work on working with the governments to understand, okay, what exactly is the value of insurance? That's number one. What are the enabling regulatory environments that you need to put in place? Often you have the insurance supervisors working almost at cross purposes from maybe what the Ministry of Finance wants. Because they want to get private capital or insurance business growing and developing in their country, but the actual environment doesn't allow that. So you need to have that. You need to make sure that that risk understanding and risk assessment is embedded in their national adaptation plans. It's beginning to shift, but it's not necessarily there yet. So, I mean, it's hard. And sometimes you get to the situation where you can line everything up, you have your policy, you have your design, you have it in place. You have also tackled the funding issue in terms of premium subsidies. You maybe, in a best case scenario, have even put in some prerequisites on risk reduction in order to get additional lending or funding or more beneficial premium subsidy rates, what have you. And then the government just decides it's not the priority right now. And it could even still be within the same political cycle, but there's something else going on that just means that they just don't have the appetite right now to just sign on a piece of paper. So it is really challenging, but I personally believe it's the only way we can go, because we cannot act on our own. We cannot be able, to close the protection gap, we need to work with communities. We need to work with other businesses. We need to work with regulators, supervisors, national level. We need to embed it also in the Ministry of Finance thinking. I think that's also another disconnect, is that it's seen as maybe something that is done with the Ministry of Agriculture, but we're talking about the economic and financial stability of a country. If they are hit by a national disaster, they're going to take those well-earned resources or precious resources and allocate it to rebuilding the country. If you can help them already mitigate the impact of the disaster, but also mitigate the impact on their financial budgets, you'd think it's a win-win. But we've got a long way to go.
Can I ask Jaime a question, because you were just triggering that? So, I mean, I remember we did a bunch of things on extended warranties in the emerging market for consumer products. And the big challenge was there, the distribution costs were just insane. If you look at dollar premium, you coughed up 40 to 50 cents for distribution. How do you overcome that in your situations?
No, it's an excellent point, because actually in many markets you have all sorts of issues like taxation is one, actually significantly increases the cost. So we're talking about regulation, right? So some elements that actually prevent you from launching products and actually making them efficiently, because actually when you have parametric, the whole point is actually getting automation to reduce cost and do it at scale with as less friction as possible. But you get in the way with these instances. And certainly when you're trying to get distribution scale with financing, the way I see it is, you look at India, for example, and there you have the scale. So the economies of scale kick in, so actually the cost of distribution is lower, whereas you look at Central America, small countries, actually the scale is not there for financial institutions, so therefore you almost understand to an extent, okay, what are they trying to do here with the economies of scale in order to make this work? So what we're trying to do is identify up front, where is it viable to deploy a solution, because the frictional cost and other regulatory issues enable us to do it, and then focus the efforts in doing it there. But we're aware that that's not possible everywhere, and that there are building blocks that need to be there in order for this to work. And that's a prerequisite to really launch this.
So I guess we're naturally drifting into the questions of the barriers as to why these solutions are not scaling as much as we would like them to, right? Because I guess what I'm hearing from the first part of this conversation is, as an industry, we actually have a lot of innovation and a lot of tools which we could use to address this. We've innovated in partnership, in collaboration, so in the way we work with governments. We've innovated in data technology. We've innovated in product structures. So, in theory, we should have the ability to deploy these at scale and start to make a meaningful dent in this. But we started to get into some of the reasons why that's not happening. And we started, I think, with some of the external challenges around regulations. And that's probably a theme which we can keep on exploring. But there are also internal challenges, I imagine, with getting the right level of investment, meeting profit hurdles. Maybe just an open question to the panelists. What do you think are some of the key reasons why we're not, as an industry, able to scale this to the level that we should be?
You know, I'll jump in. I think it's affordability and availability of the products are the biggest issues, and affordability is probably the greater. Although there is availability, this gets to some of the barriers. There are a lot of countries where you can't conduct cross-border reinsurance. Pretty hard to reinsure a natural disaster risk in a country where the laws say if you're not domiciled here, you can't reinsure. So there are absolute barriers to a significant part of it. There's practical barriers to the industry coming in and being able to set up a company or other. So, so availability is an issue because without the International Insurance Committee's help, local insurers don't have the skills, they don't have the balance sheets to do this, either insure those risks or reinsure. Important to try to bring them along, grow a domestic industry, but this problem is immediate now, and it's only going to be solved if you let the players who can solve the problem in. But then the biggest issue is affordability, and it's a minuscule amount of even donor country aid that is dedicated to pre-event funding. The whole protocol, we see it every time there's a disaster, earthquake, floods in Haiti, wherever it is. What happens is the international community passes the hat, tries to find the funds. That takes a bit of time. It's usually there, then they come and do it. Prearranged financing is becoming better understood. It's the benefit. And again, everybody's got equations of it, but $1 up front, and that's ready to be spent day one, maybe even a day before, because the hurricane is coming, but the aid can flow faster. But getting an understanding, and again, these are not for individuals, but yes, it's applicable to individuals, but it's really for countries and others to realize that if we spend money, but also donor countries, and they're beginning to do this. Germany's in the forefront of it, France is, where they're saying, wait a minute, we spend a lot of money on development, on foreign aid. What if we dedicated, because I think it's 2% of these budgets are spent on prearranged financing. What if we spent 10% of that budget by helping put in place, catastrophe response mechanisms, including, cat bonds and other insurance programs? But that needs to continue because the countries truly won't be able to afford it. Rarely are they going to be able to have the budget or the will to spend that truly special money, as you said, on insurance when, the earthquake might not happen this year, or the hurricane might not happen this year. You're in Jamaica, you think it won't happen this year, but it does. But we need to get that where the premiums are partly covered, and it makes sense for development agencies and humanitarian agencies to say, well, wait a minute, let's spend some of our money because we're going to help more people faster if we help subsidize, or in some instances, pay for the coverage.
I mean, I think on the affordability point, I think that is critical. I suppose our challenge is not just about kind of finding people to co-fund, as in the donors, but there's also an onus on us as an industry to make use of technology, data, some of the innovations that we built as an industry to deliver some of these services at a lower cost, either through better risk selection, being able to take proper account of prevention activities, or indeed do this in a more automated fashion so that it is cheaper and more accessible. Is that something which you would see as well in your businesses, or have we kind of run as much of that road as we can?
So my view is more that we need to focus our efforts more on the risk reduction, risk prevention side as well, because what is pricing? It is a function of the underlying risk. It's a risk signal. So if insurance is going and prices are increasing and getting less affordable over time, well, that's because the risks are increasing. So we have to be able to balance that out with the risk reduction, risk prevention measures. Because let's face it, if we don't do that, we as an industry are also going to be at some point pricing ourselves out of the market because we have limited risk capacity as well. The reinsurers have limited risk capacity. So at some point we will end up, and we're in that space where the protection gaps are actually scarily increasing.
Yeah.
So I would rather focus more on the risk prevention and risk reduction side and making sure that we do that in parallel so that Because some of these donors, they do offer premium subsidies and premium financing for more vulnerable exposed countries, but there's a time limit with it. So they will offer it for 2 years, and then they expect that that insurance policy will be long-term affordable and sustainable for their country, which makes sense because it has to be commercial viable as well for us, but also for the country, or affordable for the country. And so how do we make that happen is really focusing on, once you got that in place, what are we doing and how does that play into then parametric insurance triggers? How does it play into the risk capacity of the entity? Are there prerequisites or incentives that we can put in place? How does it play, and this is a little bit offbeat, but it does play a role. How does it then play into the credit risk of those countries as well? Because sometimes that will also be, that's also a trigger in terms of how do you bring in capital into a country to help support some of these developments of building better before. Investors are not going to want to do that if the credit risk of the country is really high and we're embedding climate risk into those credit risk models and calculations, fair enough, but are we actually building in the benefits of the risk reduction measures that the countries are actually taking? Right. I don't think we are.
I think you need to look at different levels, right? Because we're discussing very different things from state level, where you have parametrics as an option to generate money if needed, all the way down to microinsurance, which has a completely different mechanism. Right? I think particularly on the lower end, microinsurance, I think it all comes down to the cost of distribution at the end of the day, right? Because if you look at the usual allocation, I mean, what is it, 100 euros? Yeah, you have 40 to 50 distribution, you have 10 to 12 cost, and the rest is available for losses, and then that's, I think, the area where you get it, and I think the options there that work well is if you have contact points anyway, being it like selling seeds, so you get the agriculture, or the crop on the back of it, or via telecom operators. I got intrigued by Paul earlier today when he said, with our Indian customers, we're in touch twice a day, right? Yep. As an insurer, that's an alien concept, right? To be twice a day in touch with your insureds. So I think maybe there are options that can open up really on the direct distribution, digital distribution mobile phones, or are being used anyway.
Conscious we are getting close to time, and I wanted to leave a few minutes for questions from the audience. So I'll maybe put to the audience if there are any questions, otherwise I have quite a few more questions, given where this conversation's going.
Stunned silence.
I think there was a question. No.
You're an optimist, right?
Probably it applied to all of you, but I just met Bill time ago when Insurance Development Forum just started. So observation, did we get any better compared to 10 years ago where we are right now, or we still swimming in the same water? And it doesn't have to go to details.
The IDF just celebrated its 10th year anniversary, and I can say unequivocally, it's advanced greatly. The infrastructure within the IDF and how it engages with all the stakeholders is very sophisticated now. I don't think there's no other institution in the world that has that capability. But even with that, even with the dedicated, experienced set of people and the infrastructure and the connection points and the partnerships, for those of you who do not know, the IDF is an insurance industry-led public-private partnership. That's reflected in the steering committee. The chairman of it's always an insurer. Michel Liez, the chairman of Zurich, is the current chair of the steering committee. The two co-chairs are the World Bank and the UN. So it's and then there's all sorts of other development agencies and others that are around. So the IDF is unbelievably wired into this ecosystem, populated particularly by the insurers and the brokers that are members of it, with a huge desire, not only because of the business and the profits that can and should be made out of that business, but also by a true desire to do good. Even with all of that, we have the concern is, that's the highlight, and the concern is that even with all that, it is not really commercially sustainable, I would say. There's ways to make it so, and that's what we need to do.
Maybe if I can add to that, because 10 years feels like, on the one hand, very long time, and on the other hand, in this context, very short time. But the impact, the change, and you referred to it at the beginning, Bill, is the change that we've seen over the last 2 years in terms of engaging with the insurance industry and really bringing us into the conversation as a group, and with industry representatives, in terms of understanding what it is exactly that we do and how that actually can help in different ways is really increasing. So be it from engaging with D20 policy papers, or a couple of years ago engaging with IIS on that discussion around the triple mandate of a supervisor, be it the infrastructure fund that was just recently launched as well, and with significant amount of funding from the insurance industry as well as from IFC. There's a lot of different examples like that have come to fruition, but it has been a long haul. It is a slow process, but we are beginning to see that shift. So I'm confident and optimistic that we will be hearing a lot more from the programs that we're delivering on.
Yeah, and maybe just to add to that, it's just what we've seen is a lot of learning over the last decade on definitely what doesn't work. So that already makes us very focused on what works. Microinsurance at a low level, it's very difficult to do, but when you add aggregation, when you add hybrid models, that starts to be more viable. And actually we're getting to a point where we have a number of programs that are viable. The problem is capital. It's like, how much capital can we get to this so that we can scale it up? And that distribution piece of replicating and getting bigger and bigger, right? And coupled with the issues of affordability, fiscal space, of countries, et cetera, obviously we're in an environment which certain decisions are complicated. But having said that, at least we have clarity on what doesn't work, what's working, and some advancement. And now it's a matter of probably focusing on what's working, scaling it up, and all those that maybe are not prioritizing or there's blockage and are not following suit, maybe they just need one reference or two references that are going ahead and start to copy those because they're getting led behind. And sometimes that's how you enact change, is not trying to get everyone up, just pick a few winners and here countries that are demonstrating willingness to go ahead and adopt this, and then have them grow and others follow. Like, at least we're at a point where we can start to have that conversation, whereas 10 years ago, none of this was there.
I think it's a question over here. Oh.
Who, me? Okay. Would you mind being a little more specific about the 2 or 3 lessons learned that are working? So what is it that can be replicated? And is microinsurance purely only related to risk, or do you envisage savings also in it?
Yeah. So the public-private partnership model, India's a good example of where it's really taken off incredibly, right? And we're seeing in the agriculture sector how it's developed. We're seeing a lot of developed markets when it comes to agriculture insurance, subsidies are available. And so a lot of emerging markets are following suit, and we're seeing this is significantly taken off. Now, that coupled with delivery with good payment digital systems that can be distributed at household level is what we think is a great formula to scale up. And so that's an example of what we see working. We're seeing that I referenced the model of Social Security, of working with Social Security of countries to distribute payouts. We see that as a good way of structuring and getting the intended benefits where they are required. Again, it requires public support. It does require using a public budget, right, from the country. The equilibrium won't be a fully commercially sustained model, but still it's an equilibrium that we're finding. And then on the pure commercial basis, in markets that we were saying before, the prerequisites are there, distribution through microfinance institutions as a channel, through input suppliers when it comes to agriculture, we're starting to see significant scale there. And so bundles that are with credit and savings as well, to your question, are starting to show a lot of results. Again, it's a degree of scale that has a long way to go, for sure, for this gap to be narrowed significantly, and we are a place where you can have that conversation, but we're starting to see this happen. So I think that, at least for us, is a cause for positive thinking and saying, okay, we can double down on a few measures.
So I think we have time for one more question.
Okay, thank you. This is Clemens from MSIG Asia. One comment and one question to Thomas's comment about the 50% commissions on extended warranty cases that you've seen. We see that a lot. In Europe, I think regulators have cut down on this. See that a lot. It's mostly through digital distribution channels. And it's important, I guess, in some of these developing markets. And actually, equally like you, when I saw the first proposals coming in, I was shocked. But if you think about it, traditional bank insurance deals where insurers are paying upfront fee, profit sharing, IT development fee, et cetera, it's actually not that far away from these deals. So it's just a comment and observation because we come from the same company, and equally I was shocked in the beginning, but the more you think about it, actually, we are engaging in similar schemes for a long time. The comment or the question now to the panel is blended finance, blended capital, so working with philanthropic organizations, foundations, etc. We talked a lot about PPP. Could you make some comments about that part?
Do you want to take that one?
Yeah, I'll be quick, given the time. I guess what I'd like to think is one of the great new examples of blended finance, because it's a big word and most people will say it's very, very hard to accomplish. But as Saoirse noted, the IIS just launched 2 weeks ago. It was a formal announcement of the launch of an infrastructure fund. This is part innovation. It's a fund that was designed solely by CIOs of insurance companies, members of the IDF Infrastructure Task Force, who spent a year and a half or so just in a dark room, maybe it was a light room, but with a whiteboard, figuring out what they wanted to invest in, what they were willing to invest in. We did that, went to BlackRock. They're now the GP for the fund. But it includes first loss tranche and some other risk mitigation measures, because we knew the one thing an insurer has to have is investment grade or close to it, just because of the capital charges, which are probably still too high for that asset class by the regulators. But it was put together. The IFC committed to the fund, both as just an investor, but also helping to de-risk it. And so it was a classic case of where you need blended finance to make something investable. Everybody wants to know why the insurance industry doesn't invest more in infrastructure. They want to. It's a lack of bankable deals. And so we have to make them investable from an insurance standpoint. And we did.
Maybe to add, if I may, so you asked about the philanthropic capital, and I think that's another element that could add to the de-risking as a catalyst for private sector capital flows. So there are different options that we can look at. I mean, this is one that has just come out, but I think of course, let's figure out how we actually solve these challenges together. And that includes also the philanthropic world too.
So we are at time. It's been an absolute pleasure to have this panel here today. I think we've not quite solved the problem. I think it's going to take many years, but I do hope that when we're sitting here in 10 years' time, we can continue to say that we've shown progress as an industry and kept pace with the change in our climate. So thank you very much for joining me for this fantastic discussion today. And
Thank you.